Kenya will not sign a Sh150 billion International Monetary Fund (IMF) insurance loan intended to cushion the shilling from external economic shocks as long as it is tied to stringent conditions such as the removal of bank interest rates cap, an advisor to President Uhuru Kenyatta has said. Mbuyi Wagaka, an economist and advisor in the Executive Office of the Presidency, termed the IMF's recommendations on Kenya's economic policies as being out of touch with local reality. Dr. Wagaka's statement appears to back the Central Bank of Kenya's CBK position on the matter, sending out yet another signal of cooling relations between Nairobi and the IMF. Kenya in mid-March negotiated a 6-month renewal of the insurance loan, which expires mid-next month. The insurance facility is important in cushioning the shilling from weakening whenever the CBK's foreign currency reserves are depleted. I agree with the central bank that we actually don't need the IMF standby facility, especially when it comes with conditions that we remove the rate cap or increase taxes, said Dr. Wagaka in an interview. Kenya's foreign exchange reserves held at the CBK currently stand at about 6 months of import cover, well above the recommended minimum of 4 months. An IMF delegation that visited the country about 2 weeks ago left without making public its discussions with Treasury and CBK officials. The Washington, D.C.-based lender has repeatedly called for scrapping of controls on the cost of bank loans, insisting they were stifling economic growth by denying small businesses access to funding. Proponents of the interest rates cap, however, say the 2-year-old regulation will boost economic growth in the long term by making cheap bank loans available to businesses and households. The CBK governor, Patrick Njoroge, recently said that Kenya does not need the IMF loan, stating that the country has enough foreign currency reserves to pay its imports bills. Treasury Secretary Henry Rotich had proposed in his June budget speech a repeal of the interest rates law. The CBK's independent policy arm, the Monetary Policy Committee, MPC, recently cut the central bank rate to 9.0% from 9.5%, marking the second consecutive rate reduction in as many months. The action effectively cut the maximum cost of bank loans to 13%, which is 4 percentage points above the CBR as per the law. Before the recent cuts, the MPC had maintained the policy rate at 10% from the time the law on interest rates was passed in September 2016. Kiambu Town MP Jude Njomo, who proposed the enactment of the interest rates law, said in a separate interview that a majority of MPs are still of the opinion that the caps should remain in place. We have not held any formal meeting to discuss the issue. But I have talked to many MPs and they are of the opinion that the proposal to remove the caps will not see the light of day, said Mr. Njomo. Besides repeal of the rates cap law, the IMF wants taxes raised and a restraint on growth in public spending to ensure a lower fiscal deficit. Dr. Wagaka said commercial banks are likely to increase lending rates as soon as the rate caps are removed. Commercial banks aren't likely to change their behavior because we have done away with the rate cap. They will immediately increase lending rates and defeat the intended purpose of increasing credit to the private sector, said Dr. Wagaka.